Citizenship-based, residence-based, lump sum, non-dom program. What is all of this? The different tax systems around the world. Today, I'm going to explain all of them to you, breaking them down so you understand them better and you understand where it is you have to go to be where you're treated best. Hi, my name is Javier Correa, and I'm a Research and Development Associate here at Nomad Capitalist, where we help 7- and 8-figure entrepreneurs go where they're treated best, relocate, and improve their lives overall by minimizing their taxes and gaining significant freedom throughout their lives. Now, one of the cornerstones of the things that we do here at Nomad Capitalist is understanding the different tax systems that exist around the world so we can better serve and advise you and help you understand what tax system may be more convenient for you. Now, you may think, based on Hollywood movies, that you have high tax countries and you have low tax countries and then you have zero tax countries. Well, turns out that may be a very, very strong oversimplification. So today I'm going to try to break everything down to you in simple layman's terms to see if we can better understand everything and all the options that we have available in terms of taxation systems around the world. So I'm going to start off with the most common for most of you watching this video and is the most common throughout the West, which is the worldwide taxation system. Now, the worldwide taxation system essentially refers to any country that taxes you on income regardless of where it's earned. So this can be earned overseas or it can be earned locally. There is absolutely no difference in your country. You have to report and you have to pay tax on everything you earn around the world. Now, there are two important variants of the system. Number one, which is by far the most common, which is residence-based taxation system. This is what you have, for example, in countries like Canada, is what you have in countries like the UK, is what you have in countries like Germany, and so forth. This means that you are a resident of that country, therefore you are taxed on your worldwide income. What does this mean? This means that you can deregister and potentially become a tax non-resident of that country and become a tax resident of another country that may be more favorable. In that case, we talk about exiting the current tax system and just relocating to another tax system. The other variant, which is really only present in the United States of America at a large scale, is citizenship-based worldwide taxation system, whereby the citizens of that particular country, in this case the United States, are taxed on their worldwide income regardless of where they live, regardless of how many days they spend in the United States or of how many ties you have to the United States. Keep in mind, in residence-based taxation systems like the ones I was describing earlier, different countries might have different standards. For example, in countries like the United Kingdom, the amount of time you spend in the country is very relevant, whereas in countries like Canada, it's mostly based on the ties. So where's my family? Where's my permanent home? Where do I have my main banking? Those kinds of things. So each country may apply different criteria to what they will consider a tax resident, but globally speaking, the concept of residence is the dominant one in all of these countries. Now, in the case of the United States, it's also important to mention that it not only applies to citizens, even though we call it a citizenship-based taxation system, green card holders fall under the same system, and to a lesser extent, people who pass the substantial presence test also fall under the same criteria of worldwide taxation. And the reason why I say to a lesser extent, it's because people under the substantial presence test can more easily exit the US tax system and then come back in and then re-exit it. And there are some other rules that apply to them. Beyond the scope of this video, we might do something relating to that soon, so stay tuned. But globally speaking, this is worldwide taxation, which is essentially the most aggressive form of taxation that can exist throughout the world. Then, more or less like in the middle ground between this category and territorial taxation systems, you have countries that have remittance-based taxation systems or regimes. So what does this mean? This means that the country in question will charge tax and will tax any income regardless of where it's earned, only if it is remitted to the country in the case of foreign income. So this applies mostly to non-dom regimes. So there you have Ireland, Malta, Cyprus, the UK until next year. Unfortunately, the UK is leaving the non-dom club, as you know. Barbados is also on that list. And you have other countries that simply use this system in general, like, for example, Thailand in Southeast Asia. So let me circle back to that again to make it clear. So in these countries, any locally sourced income is always taxable, but then foreign sourced income is only taxable if brought into the country. So for example, in the case of the non-dom regimes in Europe, in most cases, with again, a few changes here and there between Malta's program and Ireland's program and Cyprus's program, etc. Globally speaking, if you have foreign income and the foreign income remains overseas, that income is not taxable. The moment you bring that foreign income into the country, then that foreign income becomes taxable. Again, with a few minor exceptions here and there, depending on the country in which you are a non-domicile tax resident, for example. In addition to that, you might find another small subcategory, which is countries like Switzerland, where you do have worldwide taxation system, but you have certain foreign income that is completely exempt from taxation. That is a bit more rare. Now, in addition to these countries, then the next category on the list would be the purely territorial tax countries. And this is where we find countries like, for example, Panama. We find countries like Costa Rica. We find countries like Paraguay. And these are countries that are essentially only worried about taxing income that derives from their soil, that derives from that country. So for example, in the case of Panama, let's say you live in Panama, you don't have to worry about taxation on any kind of foreign income whatsoever. You only have to worry about taxation on Panamanian sourced income. Now, there are some confusions that arise with territoriality, and that is mainly due to the fact that people think, oh, if my clients are located overseas or if the money is in an overseas bank account, then I don't have to worry about Panamanian taxation. That is a very common mistake. If the work is performed from Panama, then it's Panamanian source, regardless of where the bank account is located and regardless of where your clients are located. Now, if you perform the work outside of Panama, then sure, that's foreign earned income, not taxable in Panama. And of course, any investment income like foreign dividends, foreign interest, foreign royalties, all that will remain fully tax-free in Panama, regardless of remittance, regardless of where you receive the money. So you can get the money in a Panamanian bank account, and it's not at all a problem. Now, with the increasing tendency that there has been for more global transparency, the push for the global minimum tax and things like this, many territorial tax countries and autonomous territories have moved into like a semi-territorial system. And we can highlight cases like Uruguay, for example, and we can highlight cases like Hong Kong. So in both of those cases, certain foreign earned income, depending on certain conditions, I won't get into the details in this video, but globally speaking, some types of foreign earned income might become taxable in these countries in spite of the fact that they have a territorial system at heart. So it is important to take into consideration whether you're dealing with a purely territorial system or with a territorial system with certain caveats for passive income or income deriving from tax havens or blacklisted jurisdictions or things of that nature. Then last on the list would probably be the pure tax havens. So unfortunately, these countries are a dying breed. There are fewer and fewer of these every year, but they still exist. And you find the usual suspects on the list. In the Caribbean, you find places like the Bahamas. You find places like the Cayman Islands. In Europe, you find places like Sark, the Game of Thrones style jurisdiction still governed by a lord. Monaco to a lesser extent. So essentially, these are places that do not levy any form of taxation. Now, keep in mind that there are certain countries that are tax havens for individuals, but not for companies. That is the case of Monaco that I just mentioned. It is also the case of the United Arab Emirates, which recently introduced a corporate tax of 9%, but remains tax-free on the personal side. So depending on where you are and what your objectives are, you may find that one tax haven or zero tax jurisdiction is more advantageous than another. So globally speaking, when you're in a zero tax jurisdiction, essentially there is no taxation on income, no taxation on capital gains, no taxation on wealth, no taxation on anything, regardless of whether it is sourced locally, whether it's sourced internationally, whether it's remitted or not remitted, or you have a special regime or you don't have a special regime. Essentially, it's just a zero tax jurisdiction. So there you have it. That is the rundown of all the tax systems in the world. I hope this video was informative. And if you want to learn more about taxation systems and you want to go more in depth into one of the numerous countries I mentioned in this video, please do contact us. Go check out our website, assign to be a client, and follow us on Instagram, subscribe to our YouTube channel to help us help you go where you're treated best.